I drew your listeners' attention to the decade of the 70s when the US dollar purchasing power declined in excess of 75%. It's worthy to note that the gold price went up 30-fold. I'm not suggesting that we're going to have a 30-fold escalation in the gold price, but I am suggesting that the pace of increase that we've seen in the gold price will accelerate as the pace of purchasing power deterioration of the US dollar accelerates. And I think that will draw attention to gold. One more little piece of arithmetic, if I might. I realize arithmetic makes a boring show.
No.
It's useful for your listeners. Gold is way, way, way under-owned, Peter, historically.
The World Gold Council predicts that gold prices will rise at an average rate of 5% annually through 2040. This indicates a positive long-term outlook for gold as an investment. Key factors influencing this growth include economic expansion, central bank policies, and geopolitical risks. Professional investor and speculator RickRule anticipates that U.S. debt and deficits will necessitate inflation, accelerating the deterioration of the dollar's purchasing power. Drawing parallels to the 1970s, when the dollar lost over 75% of its purchasing power and gold prices rose 30-fold, he suggests that the current pace of gold price increases could accelerate. From 2019 to 2024, the U.S. dollar lost approximately 25% of its purchasing power due to inflation. In comparison, gold prices rose from an average of $1,393 per ounce in 2019 to around $2,600 today, an 87% increase. This makes gold a clear outperformer against the dollar, preserving value during significant economic turbulence. Based on fundamentals, Rick attributes the lag in gold markets to central banks driving price gains, as they don't invest in mining equities. He also notes limited retail interest, with only a few positive inflows in gold ETFs over 48 months. Concurrently, Rick critiques gold companies' poor performance from 2000 to 2010, when gold rose sevenfold. He expects that sustained gold price gains and improved operations could close the gap between gold prices and equities. From April 2022 to the end of 2024, the GDMNTR4 has declined by 1.7%, underperforming gold by nearly 38 percentage points in a rising gold price environment. This underperformance reflects investors abandoning gold as an asset class, even as central banks and non-Western investors drove gold prices higher. However, during brief periods over the past 2 years when global gold bullion ETF holdings increased, indicating a temporary return of Western investors, gold equities outperformed gold as expected. While reflecting on the market, Rick emphasizes gold's under-ownership, with less than 0.5% of U.S. assets in precious metals, compared to a historical average of 2%. A return to the mean could quadruple demand, likely driving significant price increases due to limited supply growth. Now, we present the clips of RickRule's insights from his recent interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
I think in the first instance, the lag in the gold markets is easy to explain. Gold has gone up because central banks have bought gold and they don't buy mining shares. I mean, this one's really simple. They're related markets, but the buying class has been different. If you look at the flow of funds in retail ETFs, gold ETFs, for 48 months, there's been only 7 or 8 months that had positive retail flows. The buyers of gold have been foreign central banks, and they don't buy gold. There's a different problem, of course, and that has been the corporate performance of gold companies, particularly in the period 2000 to 2010, where the gold price went up sevenfold and the free cash flow per shares fell. It took real skill to screw up an environment where the selling price of your product went up sevenfold. And so there's an expectation of failure around generalist investors. I think that the remaining institutional investors in particular are holding the gold company managements to much higher standards. It has been less evident because at the same time that the gold price went up, the cost of some inputs around gold mining has increased. And so you haven't seen the margin expansion that you would have hoped until the last 6 months. But now you are seeing some of the more efficient producers, in particular the producers that have maintained their sustaining capital costs. Lundin Gold, Agnico Eagle, Alamos, as an example. You've seen in the last 2 quarters some gold mining companies that haven't merely beat expectations, they've obliterated them. And I think that continues. You're seeing actually very good free cash flow generation in the gold mining industry. And if this performance keeps up, and if the gold price keeps going up, I'm constructive with regards to both. My suspicion is that you're going to see some of the delta, the historic delta, between the gold price and the prices of gold equities. I also believe that because of U.S. debt and deficits and the necessity, from my view, of inflating away the net present value of those obligations, that the gold price, although it's performed very well for the last 25 years, will perform better. I drew your listeners' attention to the decade of the 70s, when the U.S. dollar purchasing power declined in excess of 75%. It's worthy to note that the gold price went up 30-fold. I'm not suggesting that we're going to have a 30-fold escalation in the gold price, but I am suggesting that the pace of increase that we've seen in the gold price will accelerate as the pace of purchasing power deterioration of the U.S. dollar accelerates. And I think that will draw attention to gold. One more little piece of arithmetic, if I might. I realize arithmetic makes a boring show. It's useful for your listeners. Gold is way, way, way under-owned, Peter, historically. J.P. Morgan Chase tells us that the market share of precious metals and precious metals securities in the U.S. market is less than 0.5%. Although J.P. Morgan doesn't have data going back 40 years, they estimate that the mean market share of precious metals and precious metals related equities is 2%. So if interest in the stuff merely reverted to mean, demand increases fourfold. I'm not smart enough to tell you what that would do to price. I have no earthly idea. But one would suggest that a fourfold increase in demand, at least on the precious metal side, if not the precious metals equity side, where supply growth is fairly constrained, would have a very outsized impact on price.
In the interview, RickRule critiques Trump's understanding of the U.S. government's financial liabilities, which exceed $136 trillion when combining on- and off-balance sheet obligations. He points out that this growing debt, coupled with Americans' limited private net worth, suggests that the government's ability to cover its liabilities is strained. Trump inherits a strong economy, with the U.S. pandemic recovery outpacing other advanced economies across inflation, productivity, and growth measures. But beneath this surface lies a troubling fiscal reality. At over $36 trillion, over 6 times its 2001 level, the national debt is unsustainable, with the debt-to-GDP ratio poised to hit record heights under Trump's second term. Given the number of billionaires in the Trump administration, it would be sensible for Democrats to embrace a populist tone, but they need not surrender on fiscal responsibility. Pitching loophole closures and rate raises for corporations and wealthy individuals can serve both populist and fiscal ends. According to RickRule, the government may erode its obligations' real value through inflation, similar to the 1970s. Let's get back to the interview.
The good thing about Trump is he doesn't have to run for re-election, so perhaps he's got nothing to lose. I don't think he has a way to win. Let me give you some arithmetic, Peter, that I'm not sure that Mr. Trump has paid attention to. The on-balance sheet liabilities of the U.S. government, which is to say the debts of the U.S. government to bondholders, now exceed $36 trillion. For reference, that's 120% of GDP. But that's not the real problem. The real problem is the net present value of off-balance sheet liabilities. That is the entitlement promises that we've made to Americans. Federal government pensions, which are promised but unfunded, military pensions, which are promised but unfunded, the Environmental Trust Fund, which is promised but unfunded, Medicare, Medicaid, and Social Security, all of which have been promised but unfunded. The Congressional Budget Office, not some cranky old libertarian named RickRule, but rather the Congressional Budget Office, suggests that the net present value of unfunded promises in the United States exceeds $100 trillion. So let's add together the unfunded promises and the on-balance sheet liabilities. You got $136 trillion. Now let's take off $6 trillion for the Fed's own holdings of treasuries. You have $130 trillion in net debt. Two problems here. That number, again according to the Congressional Budget Office, grows by $5 trillion a year. That $5 trillion is the equivalent of the gross revenues of the federal government on an annual basis before they pay any of the expenses. But it gets worse. The Internal Revenue Service suggests that the aggregate net worth, private net worth of Americans, not the value of government assets, but the private net worth of Americans is $141 trillion. So the arithmetic exercise for Mr. Trump is to take the aggregate net worth of all Americans, including himself, which is $141 trillion, and subtract the net indebtedness, which is $130 million. The number that he would get if he did the arithmetic correctly is $11 trillion. the $11 trillion would fund 2 years of deficit. Now, I'm interested in how he plans to attack that. I mean, I can tell you what I think will happen. What I think will happen is that politically they will honor the nominal value of their obligations. Some old geezer like me will get the promised nominal value of his or her Social Security, but they'll inflate away the net present value, just the way they did in the decade of the 70s. According to the Office of Management and Budget, in the period 1970 to 1980, this is a government number, the purchasing power of the US dollar fell in excess of 75%. So they were able to honor the nominal value because taxes weren't indexed to inflation, while they inflated away the net present value. And I think that's precisely what happens in the next 10 or 15 years.
Forecasts suggest that gold could reach around $6,800 per ounce by 2040, reflecting a rate of return of 7.2% annually. This projection underscores gold's potential to deliver returns surpassing typical investment assets. Do you think gold will continue outperforming traditional assets in the years ahead, especially considering the current fiscal challenges? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.